Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, folks, if you really want to know what's going on in the investment universe, you really want to talk to the folks at Charles Schwab. It is a great place to start. First of all, it's a $175 billion market cap company. Stock is up about 26% year to date. Following its recent earnings, at least 11 analysts raised their price target on the stock after Schwab's third quarter earnings beat, thanks to a surge in retail investing activity, and it's something we certainly want to dig into.
Yeah, let's talk about some more numbers behind the firm. $11 trillion, more than that in client assets, 38 million client brokerage accounts, 2.2 million bank accounts, 5.6 million workplace plan participant accounts, and over 16,000 independent investment advisors. Thousands of them are here at Schwab Impact 2025 in Denver.
Now, Rick Wurster took over as CEO in January of this year after previously serving as president for about 3 years at the company. He was head of Schwab Asset Management Solutions before that. So you have been at the company for nearly a decade. Is that right?
Yes.
Welcome. Thank you.
Thanks for having me on, and we're so thrilled that you made the trip to be here in Denver at the conference.
Well, we love coming here because we really do feel like it's good to get out of, I feel like, the coasts. And I feel like it's good to talk to the people who are actually managing tons and tons of money on a daily basis. Talk to us about your first year and some of what's been coming at you and how you and your team are making sense of kind of the investment environment when things can change often on a day-to-day basis.
Well, the most rewarding part of the first year has been serving our 46 million clients. And it's been a year in which the value of what we bring to the table, great in-person experiences, the leading digital app, the strength of our bank and wealth capabilities, where all of those things have been necessary to help clients navigate markets. So that's what I take most from the first year. It's just such an incredible opportunity to serve our clients and the 16,000 advisors on our platform, many of whom are here. It's a real honor to be their partner in business.
Well, the market environment right now, we want to dive right in there because really this week we've heard from different Wall Street executives that an overdue collection have weighed on the market this week. So reduced expectations for Fed rate cuts, a prolonged government shutdown. Michael Burry added to the negative tone with his disclosure of bearish wagers on Palantir and NVIDIA. Dip buyers, though, coming back into the trade today. Retail investors have been buying dips. How do you see today's environment from sort of a risk-reward perspective?
Well, we try to focus our clients on the long term. I think that owning securities and assets over long periods of time will generally go up. It's really hard to get the timing of markets down because you have to make two correct calls. First, you got to nail it to get out at the right time, which is really hard in the strength of the kind of market we've had and the momentum we've had. To get out at the right time is incredibly hard. And then you've got to be able to get back in at the right time or you miss out. I was down in Charlotte, North Carolina, visiting with some clients, and I heard from one client who back in 2016 didn't like the presidential administration and so had sold out of stocks. And this was back when we were having a pullback, and they said would now be a good time to get back in the market. And they'd sat out a huge amount of gains over a short-term point of view. We try to have clients avoid that. If clients can stay in the market and tolerate some volatility, we think over the long run that gets rewarded. Because it is so hard to call the markets both when to get out and when to get back in.
So as you walk around the floor and you're talking to advisors, I mean, what are they talking about, in terms of timely advice that you're getting maybe from the advisors and what they are kind of hearing from their clients?
I think one of the most pressing topics from investors today is how to navigate concentrated positions. The S&P is as concentrated as it's ever been.
Right. The Mag 7, the big tech.
Yes, and it's created tremendous wealth for lots of retail investors. And now they're wondering how to diversify their portfolio and to do so in a way to minimize their tax burden. And there's all kinds of strategies that they can work with their advisor on to create a more diversified portfolio without having to pay a tremendous amount in capital gains.
How hard is it, though, that when clients are like, but why would I want to get out of NVIDIA when I've seen what they've been doing for how many years? Like, how tough is that? Because we constantly have conversations of people saying it's time to, broaden out, back off the big tech. And then it's the big tech with so much momentum.
Well, you're absolutely right. And it's a really hard conversation to have. And oftentimes we don't win it, but we want to make sure the client is cognizant of the risk and the choice that they're making.
Yeah.
And to be fair to those investors, they've been right by sticking with their concentrated position for the most part, because the names that have driven the market higher have been the same ones here for a while. And so many people have stuck with it, and they are sitting on more gains than they might have anticipated.
So let's go further into the retail trader, because they've grown to about 20% of the U.S. equity market today. I'm curious about sentiment trends, like how the structure of this trend. How resilient are retail traders in an eventual downturn?
Well, I think retail traders have been the ones leading the market higher and have been the ones buying the dips, and I think they were out actually in many ways out ahead of the institutional buyers. And so I think you have a retail buyer that has strong hands and will stick through the market. So we'll see how it all plays out, but markets go up and down, and retail investors will inevitably make some decisions in there that's best for them.
People hear retail investor, they think about Robinhood, for example. Your customer versus Robinhood's customer base. What are the differences there?
Well, our customer is an incredibly thoughtful group of retail investors. First, they have access to what we think are the best investing platforms in the industry. Number two, they have access to the most robust research platform. We produce 35 hours a week of live education and training for investors so that they're making the most informed decisions. We also don't make them choose a channel. Not only the leading digital app, but they can walk in and talk to someone. They can call our phone and get their question answered in less than 30 seconds. We have 1,000 professional traders that wake up every morning ready to answer the phone to help our clients trade. So I think we bring everything we can to help our clients be successful, and I think they make thoughtful decisions that are best for their financial life.
Now, you guys have talked about 1/3 of your clients are Gen Z. So talk to us about how you continue to bring them in. How do you defend them, keeping them in? What do you need to kind of do to serve them and keep them on your platform?
Okay, so 1/3 of our new-to-firm clients are Gen Z, which is between the ages of 13 and 28. We are having tremendous success.
Forgive me, that was new customers, right?
It's new customers, but we're having tremendous success with the young investor because we see through their eyes, and we put all the weight and strength of our firm behind helping them live their best financial life and make the smartest financial decisions for them. We don't just say, hey, here's a platform, go for it. Certainly many want to do that, and they can have at it. But we also stand behind every one of them if they want access to our research, they want to talk to a professional. And in terms of where we're finding them, it's interesting. I went to our marketing department and I said, hey, I don't see enough about our advertising to young people. And they said, Rick, it's because you're not cool and in the places where young people go. But
did that hurt?
It hurt a little bit. We're the #1 followed financial services company on YouTube.
Yeah.
We're all over TikTok. We're on all these different places where young people are, and they're attracted to the breadth of the Schwab value proposition and how different it is than other offers they see in the market.
Well, speaking of what's out there in the market.
Wait.
Luke, go ahead.
Are you going to ask about crypto?
No, not yet.
Do you want to wait?
Yeah, I want to wait.
All right, go.
I want to ask about prediction markets.
Okay.
Because this is something that I think Gen Z wants. And Polymarket is back in the U.S. It is certainly related to crypto.
Right.
Carol, what role does Schwab have in prediction markets in the future?
Well, I think prediction markets started out with financial services companies with the best of intentions. They wanted their investors to be able to bet on what was going to happen with the inflation report, what's going to happen with the job report, or what the Fed's going to do. And they realized that there's not a lot of volume and interest in those events in the general public, and that there's already ways in financial markets to invest around those activities. And then the election happened, and the volume in prediction markets skyrocketed,
right.
And these companies got a windfall of money. And then they said to themselves, well, a presidential election only comes one out of every 4 years. How do we generate this level of interest on more of an ongoing basis so we can see this windfall more regularly? And then they migrated from things that were tangentially related to financial markets to pure sports gambling, because every Saturday and Sunday there's lots of activities that the nation cares about. And now I think we're in a world where what's driving all the volume in prediction markets is pure sports gambling.
So, yes or no for Schwab getting involved?
That's something we gotta keep an eye on.
You're considering it?
We're not actively considering it. And the reason we're not actively considering it is our mission is to make our clients better off in their financial life. 5% of people, and actually I read this on Bloomberg very early this morning, 5% of people that put money into a gambling app take out more than they put in the first place. So gambling has proven to be a net negative contribution to your wealth. Now, it's fine if you use it as entertainment and you're doing it in a thoughtful way, but our mission is to make clients better off in their financial life and enhance their wealth.
Does that then say to you that it's not a good idea in terms of the prediction markets and kind of mixing them with traditional investing?
From my viewpoint, we want to do everything we can to put our clients in the best chance to grow their wealth.
Right.
And I think it's fine for people to gamble. People are going to gamble. Hopefully they do it in a responsible way. The thing I worry most about is the conflation between gambling and investing. If you're a young investor, you've got $10,000 in your account, you can move it easily between investing in a stock that over the long run is likely to go up over the course of your life.
Right.
Or you can go bet on the Eagles game that weekend. I think that is not the greatest thing for the retail investor.
Speaking of gambling and perhaps gamification, crypto. Where does crypto fit into all of this for you guys?
Well, crypto has become an asset class that many people have their full confidence and trust in, and they view it as a store of value.
Right.
And on our platform, we have lots of people engaged in crypto today. In fact, our clients own 20% of all the ETPs, crypto ETPs in our country. So our clients are big investors in crypto, and for most people, buying the exchange-traded product is the right way to go because they're not looking to transact in Bitcoin. They're just looking to get exposure to the price movements. Now, in addition to offering the ETP, we will, in time, offer spot crypto, and we're confident that we've got clients that are sitting at digital native firms that have been long Schwab clients that we know want to bring those assets back to Schwab, and we're looking forward to being able to do that.
This year, next year?
Next year.
Still first half of 2026?
That's what we're shooting for,
okay.
And so far, so good.
May, June? You have an idea?
I'm not going to get that specific. I'd get slapped later by somebody.
Well, last
we don't
year,
want that to happen.
Speaking of, last year you sat in this chair. We were in San Francisco, and we had a fun conversation about crypto. You made headlines. You said, this was a year ago, I have not bought crypto now, and I feel silly. You also said crypto investors have been right and that you haven't been right. So update us. Have you bought crypto since then?
I have not bought crypto. I have nothing against crypto. I can certainly see the case of it. If people believe it's a store of value, it is scarce and it could go up. I think the blockchain is something that is likely to play a bigger part in markets, and therefore crypto can have some value around blockchain. Well, for me personally, my investments are in assets that I consider to be productive assets. They're generating earnings, they're generating principal or interest, and that's where I focus my investment portfolio.
It's interesting that you say that because when you said that comment to us last year in the middle of November, Bitcoin was at, and we were talking about Bitcoin, was at $100,000. Right now it's at about $104,000. So you look right by not actually getting in right then.
Possibly. And Bitcoin and crypto generally is going to go up. It's going to go down. Its volatility is something, its standard deviation is something like 50%. So we should expect wild swings. And for the right group of folks, they want to own it. They believe passionately in it. And they should have it as part of their portfolio. For some investors, it's what they want to invest in.
Private credit, private markets. How about that in terms of, you think, the role that will play
in our retirement
investors'
accounts?
Portfolios?
In our retirement accounts?
How do you feel about that one?
Well, you're a great private company. There's lots of great private companies in our country that have done really well.
Right.
I think retail investors should be exposed to private opportunities. We would like to bring it to market in three ways. Number one, we provide access to retail clients to great alternatives managers in private equity, private credit, venture capital, a lot of the names that you're familiar with. Second thing is, I think at the right time, we would love to be able to offer passive exposure in a fund-like structure to private markets. Just like in public markets today, you can go buy, the S&P 500 index fund and get broad representation of stocks. You should be able to do that in private markets. We'd love to play a role in that in the future. And then third, like you can buy individual stocks if you don't want either the active management or the passive exposure to the broad market, I think that marketplace for single security private companies should expand over time. And so those are the three ways we envision the market expanding, and we want to play a role in all three.
Do we have to wrap? Can I get you 20, 30 seconds on elections and changes and environments and I think the midterms and what might happen next time at the White House? How does that fit into your thinking in terms of long-term strategy for the company? Because we've had a volatile year a little bit. Markets
have thrived through all types of administrations and changes in presidents and changes in the Senate and House and all of that. And so our message to clients is stay diversified and be invested and stay invested and have a plan for your financial life. And if you do those things, they'll navigate different ups and downs associated with different administrations. And That's our counsel to clients.
All right. So appreciate your time, as always, and fun to be at your event.
Always love seeing you here, and I appreciate the commitment you both made to be here in Denver and be a part of the Impact Conference. Thank you.
Well, hopefully we'll see you next year and more between now and then.
Yeah, exactly. Rick Wurster, President and CEO of Charles Schwab, of course, kicking off our coverage here at Schwab Impact 2025. We are here in Denver. Rick, again, thank you so much.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I got to say, gains in the S&P 500, just want to mention, since April, have seen the U.S. benchmark decouple significantly from its moving averages. The gap with the 200-day gauge widened to 13% in October. That's a level that's usually proved unsustainable in the past 15 years. Meantime, the index is now traded above its 50-day moving average of the longest since 2011. So
everything is awesome?
Everything. I don't know. We're going to ask Liz. She's shaking her head.
Let's get into it with Liz Ann Saunders. She joins us here at Schwab Impact. She's Chief Investment Strategist of Charles Schwab. Everybody knows Liz Ann Saunders. How are you?
Yeah.
I'm good. I'm so glad you're here
Thank
again.
you.
Welcome to our cozy little event.
5,000 people or
It's
so?
not cozy and it's not little, but we are happy to be here. It's a huge event. It was huge last year in San Francisco. It was huge the year before that in Philadelphia. Mm-hmm. You were shaking your head when I was saying everything is awesome. Why?
Well, it's a bit of a tale of two markets. You've got cap-weighted index returns and the lack of any significant downside, particularly since the April 8th closing low. But here's an example. The average member within the S&P just since April 8th has had a 16%, now actually 17% drawdown. The average member within the NASDAQ since April 8th, when the NASDAQ's up 50 some odd percent, has had a average maximum drawdown of 36%.
So the breadth isn't there.
The breadth isn't there, but there's a lot of churn and rotation going on under the surface that you don't pick up if you're only looking at the index level returns.
So do you think the pullback that we saw, which wasn't really much yesterday, but do you think are we starting to see signs where investors are kind of questioning some of the valuations that are out there, the AI spend and whether we're getting the return on investment on it? Tell us your thinking here.
I think the margin of error has narrowed a bit. There's obviously sensitivity, whether it is diminution in return on invested capital, whether you're seeing pressure on margins. Obviously, the concern about the circularity of financing and the fact that so far
that's a real thing, right?
It is a real thing.
I mean, we are kind of blown away. What feels like it's all in the family.
Yeah, here's $5 billion, so you can buy $5 billion worth of stuff from us.
Right.
You guys at Bloomberg had this incredible visual that I think made it on Michael Burry's post.
We were talking about the post.
Yes.
But that is such a great visual. I've seen more simplistic ones of a power strip with the plug plugged into the power strip.
Yeah, but that's exactly true, right?
And I think, the boom so far has been financed out of cash flows. It's been largely equity financed. But now you've got, to just pick on the Mag 7 cohort, Mag 7 free cash flow growth has gone from more than 60% year over year 6 quarters ago to now 2 quarters in a row of negative. And so you're starting to see more deals financed with that. That's not necessarily a bad thing. It's just a different environment.
But that I do want Meta and Alphabet, right? Didn't they just recently do it? Oversubscribed, like there was lots of investor interest. But I don't know, Liz, what we just have to keep an eye on it or what?
Yeah, I think, valuation is a tough one. I think valuations, and I'm going to say this generally, not just specific to AI stocks or Mag 7. It's not a market timing tool. It's more a temperature gauge than it is a timing gauge. It's almost an indicator of sentiment. There are times where valuations can get stretched and they can get more ridiculously stretched, and the market still has a long runway ahead of it. So I think it represents some of the angst that's coming into the narrative right now, but it doesn't necessarily portend impending doom. It's just it's a cost saver, AI. And it boosts margins. So we had the early focus solely on the hyperscalers and the chips, and then more recently it's gone into the energy usage and the data centers. Mm-hmm. Now I think where you're actually getting meat on the bones in terms of productivity statistics, in terms of the beneficial to costs is the users of AI. And I think that is likely to continue.
But then does it create this destructive element in our society as a result of those entry-level jobs, those white-collar jobs, those blue-collar jobs that end up being completely eliminated? I mean, I know we're talking about a future that none of us can see, but we had an interesting conversation with David Weston last week, and he was basically like, how do we have this payoff without the money savings from getting rid of all these employees, basically?
I think that we're in a moment of creative destruction, to quote Schumpeter.
Yeah.
And that happens anytime we have a major innovation or we've shifted our economy from being an ag economy to industrial to innovation, and that happens. But ultimately, new types of jobs are created. I actually think that companies that don't adopt AI are going to have more job losses. I think what we need to bring in is what AI doesn't yet provide and maybe won't ever. The C's, creativity and culture and community and connection, context. So I think I still think AI, yes, it is replacing certain kinds of jobs, but I think it's replacing tasks more than it's replacing full occupations. But I think workers have to adapt to it and adopt it and bring it into their lives, or they will be left behind.
I pulled up my phone because someone came up to us, and Dwayne, who is a financial advisor, he's here, and he said you guys did something on AI.
No, he said you.
I did.
You did something on
AI. At an event, and we had somebody who showed how to use AI, and he said, after that, I went home and started playing with ChatGPT.
This was the panel you did at this conference last year in San Francisco.
No, it wasn't.
No?
I don't think so.
Okay, well, it was something.
But anyway, there's a lot of stuff going on. But what he said is he was able to ask it questions, do analytics so much faster. It was accurate. And he said it just took less time.
Right.
And I actually produced better returns for my clients, which was pretty cool stuff.
It is a game changer, but the hallucination rates are still high enough. They're low single digits, but high enough that I think it was Gene Munster. He spoke right before me at a recent conference, who said, LLMs are like an intern. They do a lot of the work for you, but you kind of have to check their work.
Got to keep an eye on them.
Yeah.
Next 6 to 12 months, what do you think the investment environment looks like?
I think these bifurcations that have pervaded the economy, even the inflation data, and obviously the stock market, I don't see a convergence to any significant degree. I think you're going to still see those bifurcations, whether it's from a CapEx perspective, AI or non-AI, asset owners versus non-asset owners, high-income consumers versus low-income consumers, tariff impacted goods versus non-tariff impacted goods from an inflation standpoint, and then obviously all those bifurcations. What I would watch for that may be interesting is we could have a situation where if some of the mega cap names, some of the leadership names continue to have some sort of pullback phase, watch what the rest of the market does. I don't think it's going to be extreme as late 2022, but what was interesting about that low in October of 2022 relative to the low prior to that in June of 2022 is that when you had the real crush, there was greater participation under the surface. That's what you want to look for.
We will do that. Liz, thank you so much.
Always great to see you
Liz
guys.
Saunders,
Thank you.
Same here, Chief Investment Strategist at Charles Schwab.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Can't wait to get to our next guest. We're going to have a lot of fun with him. Omar Aguilar. He's CEO and CIO of Schwab Asset Management. We're just talking about just how much money is under the Schwab universe. We're talking about $1.6 trillion in assets under management.
Omar joins us here on site at Schwab Impact 2025 in Denver. Good to be with you again. How are you?
I'm doing very well. Can't you believe this is the 35th year we have done Impact? And for me, it's 14 years. It's just unbelievable.
Well, let's talk about this year because as we were chatting ahead of this interview, you made the joke, I wish we could just end the year right here because it's been a good year. It's been a good year. But what does that portend for the next, 2 months?
It's been great for investors. It's been great for investors to actually see this. I would probably say there were many points throughout the year where we all wish things were actually going to be different. And I don't think anybody anticipated, that we're going to be at this stage, so far into this year. From the beginning of the year, the uncertainty around administration to Liberation Day to recovery to, the rise of AI to the economy, the consumer, all the way to where we are now. It's such been a ride that I think investors have taken advantage of.
I was thinking about your background, and I just want to lay it out. You've got 25 years of investment management experience in equity markets. You've seen a lot of cycles, and I think I often reach out to you guys to ask you about this. What do you make of some of the recent stress that we've seen, Omar, whether it was concerns about credit, some of the regional bank issues again? We've heard different stories about whether or not credit concerns were something that might linger for a little bit. And then there's the private, credit market. So how do you see it? And do you see it at all impacting kind of the tone of trade and activity on your platforms?
Yes, it is interesting because, yes, I have seen a lot of cycles.
I have too. So we're just like a good bottle of wine.
My gray hairs, I'm taking pride of it. But yes, it is interesting because, what I have seen historically is you actually go to the source of what is actually maybe the reasons why something cracks. Mm-hmm. There will always be in every single cycle, areas of risk that are what we call idiosyncratic. That's just a fancy word. But, what that means is that there will always going to be things that will happen that will make people nervous. And we just need to understand whether it's systemic or it's just isolated to certain area. Interesting enough, you mentioned about, the credit market. The credit market has been incredibly resilient since 2008. And I think when you look at the current, even the high yield market, it's not as junky as it used to be. I remember back in 2005, 2006, or 2001 and 2002. Those were periods where you will really feel that there was a lot of delinquencies, there was a lot of risk, there was a lot of uncertainty around them. When you look at it today, the delinquencies are growing,
right?
But not outside of the norm what you will have in this part of the cycle.
Why do you think that's not happening?
Well, a lot of that has to do with corporate America. Their balance sheets are fairly strong, and the amount of leverage that you see in corporate America is basically to the lowest in many decades. So what that actually means is that yes, companies that are taking excess leverage, excess risk, and they're more risky in the way they manage their business, they're clearly more at the risk end. Yeah. But the majority of America, it's actually pretty solid in terms of how they manage their balance sheets. And in fact, a lot of the reasons we were talking about, in other forums about the reasons why tariffs have not been having the impact as big as it has been is because profit margins have been very, very benign and have been not been affected as much.
So does that mean that it's only a matter of time before we actually see inflation as a result of these tariffs when these companies say we're not going to pad the impact anymore with our healthy profit margins? We're ready to pass these on?
Well, we're already seeing some of that. We're already seeing two things. One is we're already seeing companies that they're not going to have a choice but actually pass through those increasing prices to the consumers. We have seen those companies that have the biggest opportunities and the biggest, widest margins. They're already good. But there are ones that are getting squeezed. We already see some of that already in the early parts of this earnings season. The second part that we're observing is consumption. Consumers and the demand destruction is starting to happen. You're starting to see a little bit in terms of airlines and the tickets. Mm-hmm. And, you see that actually on my way here for the first time, the plane was not full. That was unique because, for the entire year, you always go there and it's actually a big chunk of it. So you can see a little bit of that consumption starting to just get affected by it.
This happened to us last month on our way back from Los Angeles. The person at the gate said, "This is crazy. It's been full pretty much until now." The flight was empty heading back.
Yeah.
Again, it's an anecdote. Yeah, we're not hearing it from airlines yet. But
airlines have been so smart about keeping those planes packed, right? Yeah, so to me, it seems like a clear indicator. I know I said you've seen a lot of cycles, but I think about your background, Lehman Brothers, mm-hmm. Merrill Lynch. These are firms that are no longer around, post GFC, the great financial crisis. So I guess I always try to think, what are we missing in an environment where so many people are like, it's okay, it's okay, it's okay. And I'm like, what are the possible risks, do you think, for investors in this environment?
Well, we have seen, and actually we saw this in the last 6 weeks. If you look at the performance of those companies that do not have positive earnings, negative earnings companies in small and mid-cap sectors, they outperform by almost 20% in a short period of time. So what is called the junk rally. And in many cases, the concern is that this component of excess goes into areas that goes like that, and that volatility is not healthy. Volatility when you have something that is extreme valuations, they're still generating earnings, but you know that their multiples are way ahead. It is normal and it's healthy. And in fact, I tend to do this to clients and advisors here to say, hey, look, some volatility is healthy. You don't want a straight up market. I think the exposure to momentum is one that I have seen in many cycles. It blows up. It goes very quickly up and it just blows up very quickly. It doesn't have to be all the cancer. So the concern we have now is that there's too much momentum in the market or still. And it needs to be, somehow corrected.
Is it the AI trade momentum?
It is beyond just the AI trade.
Okay.
The AI trade, if you look at it, a lot of that is being represented in CapEx. So the capital expenditure from majority of companies has translated into AI, and those companies are generating flows. Not all AI companies.
But now they're tapping debt markets.
They're tapping debt markets, and at the same time, you're starting to see that there's companies that are spending in capital that they're not seeing the returns. They're starting to just being questioned about their capital expenditures and their ROI. So I think some of that, it's healthy. It is the right thing. Not all AI is going to be the same. And I think, to me, that is a good thing for that consolidation. A little of those pieces will actually come to break.
But if there's a blow up, is it the AI thing or is it something else maybe in terms of risk?
Well, I think it's just generally market because the concentration risk is the one that worries me the most. If you think about until this moment, only 30% of the companies in the S&P 500 have outperformed the index. The rest have underperformed.
Right.
So you can actually just feel how that translates into, significant amount of rebalancing that needs to happen for this to continue. And again, going back to what you said, this is repeated. In the past, you've seen it was energy at some point. It was, consumer discretionary at some other point. It was tech back in the 2000s. So this time, even though it's not the same as with back there because companies are generating free cash flow, still, you feel that there's going to be some rebalancing that needs to happen.
Who do we have to talk to get more time with you? I'm just going to put it out there. We want to talk more to your people so we can get more time with you. Omar, thank you always. Always appreciate it. Omar Aguilar, he's CEO and CIO of Schwab Asset Management.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Yesterday on the plane,
I'm writing my intro for Kathy Jones, and I'm like,
furiously.
Oh, I got some stuff to talk about because there's a flight to quality happening right now.
I like that you did that.
And then today,
I know.
It's basically like, erase the whole intro.
I know.
The flight to quality that we saw yesterday
exactly
isn't happening.
I don't know.
Kathy
we got
Jones,
some decent maybe data today.
I guess that's what it was. But does that change the narrative?
I
thought
know.
yesterday it changed the narrative.
What is the long-term narrative?
Let's see what Kathy Jones has to say. She's Chief Fixed Income Strategist at the Schwab Center for Financial Research. She joins us here on site at Schwab.
She has to
Denver.
figure out the longer-term narrative.
Well, I thought yesterday was kind of this turning point. With this flight to quality, we saw equities sell off. There was this chorus of Wall Street executives who were like, okay, not so fast. What did you think?
Yeah, it certainly felt like the stock market was getting a little, yippee. What is the...
That's what the president said earlier this year.
Yeah.
But he's about the bond market, he said it.
Yeah, I know.
Yeah,
I know.
As you know.
Now it's their turn at the stock market. And so I thought, we had a decent bid in the bond market, but it wasn't huge. In the times past, if you had a really good sell-off in the stock market from elevated levels, you'd get a big jump. And we didn't get a big jump.
Why didn't we?
I'm not sure that the bond market has a lot of room for longer-term yields to go down, absent a very big change in the economic outlook.
So there's a floor, you see.
Yeah.
Yields.
Is a big change in the economic outlook if the Supreme Court says, sorry, IEEPA tariffs?
Yeah.
Those are not legal.
Yeah, I don't think that has a big impact on the bond
market. It's $100 billion that could go back to companies and consumers.
Debt we have?
Yes, I do. Trillions.
In terms of the bond market,
and
$100
growing
billion is a fairly small drop in the bucket. Then how fast does that actually get back to somebody's pocketbook for spending? But in general, the economy seems to be chugging along.
Right.
Okay. It's not great for everybody, but in aggregate, it's good enough. Inflation is stuck at 3% and kind of edging higher. Where do we go from here? If you've got inflation at 3%, maybe moving up and a 4% 10-year yield, that's equilibrium right now. We need something to change. And
do you think it's going to change?
I think in 2026 we'll probably get enough slowing growth and some easing in inflation that we'll see yields come down. But I think the market was just way over its skis, expecting the Fed to cut over and over again. And it is very difficult to forecast all the time, but now between tariffs on, tariffs off, no data, policy shut down, policy making shut down, I think the market's just the bond market's kind of just going, whoa, we're pretty well priced. Let's just sit here and wait for things to happen.
Well, so then does that increase the chances, Kathy, you think, of the Fed having a policy misstep here?
It's certainly a possibility, but I think my impression that I get from Powell and from many of the other members is, look, we're back to this navigating on a cloudy night thing, right? We don't have information. The path ahead isn't clear. And we've taken a couple of steps. We're not restrictive anymore. So now we pause and we wait and see what happens. We go slow.
I'm a sailor, and I've navigated at night, and it can be kind of not so great.
Yeah.
You can hit a rock, or you can hit something because you just don't read something correctly.
Right.
Or things can be smooth sailing.
Yeah.
So is there a chance, though, that I think so many people are shocked that the economy is still growing and we're kind of doing all right, and the market continues, the equity market, to hit highs. Not necessarily what everybody was predicting a few months ago, but I just do wonder, what's the thing we could be missing?
Well, right now financial conditions have been very supportive.
Yeah.
Right? And I think that's another reason the Fed can kind of wait. They're saying, well, there's no evidence that the level of interest rates is holding back the economy. People can borrow as much as they
Except
want.
for housing still a little bit.
Yeah, maybe, but I mean, even housing's starting to kind of recover because prices are adjusting. So, what is the thing that gets us? It's never the thing you're looking at in your face, right? It's the thing you don't know. I'm worried about the buildup of debt, behind the scenes in the shadow banking system.
Private credit?
Yeah, to some extent. We know that the quality isn't great there, and we know that some firms are struggling. So,
how would a crisis like that in private credit manifest?
I think the issue is who's lending to the private credit folks.
Don't the banks lend to the private credit folks?
Yeah.
So,
right.
What's their exposure?
Well, we don't know. Because private credit is private, it's hard to know the quality of the assets in any given day.
Your
right?
face is really telling. Are you concerned that the exposure by the banks is a lot more than we know?
I think the banks, no. I think the the major banks are fine because against their will, they've been forced to hold a lot of capital since the Basel rules. And so I think the banks are okay. But it does get to be sort of a cascade, right? One thing leads to another, and a lot of interwoven lending takes place, and there's hidden leverage. And that's where you worry about things starting to change. I don't have any particular...
I didn't mean to put you on the spot.
No, I don't have any particular, like, this guy's going to blow up story to tell. These are the ways in the past we've run into trouble. Somebody gets over leveraged, asset prices get out of whack, people are overconfident, and then things change.
Right.
So it kind of brings us back to the Fed and how the Fed works in an environment such as this, in an environment where it's not getting much data. We did hear from Lisa Cook this week. She said she sees the risk of further labor market weakness as greater than the risk of inflation will pick up. Chicago Fed President Austin Goolsbee said he was more nervous about inflation. Who's right?
Yeah, we'll find out.
We'll find out when we reach our destination.
Yeah, I'm more in Goolsbee's camp right now. Although the labor market has clearly softened, some of that is supply side, right? So we got the ADP numbers today. It was a positive number. who's to say that number isn't consistent with equilibrium in the labor market?
So are these numbers accurate now? Because
ADP is as accurate as we can get
right now.
Yeah, at the moment.
But when we used to get government data, we used to get the ADP numbers on the day before, or a couple days before.
Right.
Day before? I don't even remember.
It was
this
the same
world
week,
that we
Wednesday,
don't.
right?
Yeah,
Wednesday.
we'd get them earlier.
Yeah.
And then we'd get the numbers from the government, and they would oftentimes not even be close to one another.
Yeah, and that's true. I think part of that is ADP is private sector only. They didn't include government workers, so there's that discrepancy. And their surveys are different, but it's all we've got to go on. So it looks like that they're picking back up a little bit, and that's good news. The ISM figures, the manufacturing figures were okay today, with prices paid continuing to climb.
But then you have these fast casual restaurants coming out and saying, hey, we're not seeing the young consumers come in and spend $15 on a lunch. Forgive me, slop bowl, but that's what they're called now, because they're feeling squeezed.
Yeah, and that's
an indicator.
That's the issue of the economy's working well for some and not well for others. And we've seen problems in the car loan market, usually subprime borrowers running into trouble. I am concerned about the agricultural sector.
Right,
they've been really hard hit by tariffs, and it's not just farmers or agricultural businesses, it's their lenders. We have banks that lend in that sector as well. So these are pretty good sized parts of the economy, but we've got then the CapEx spend, wealthier consumers continuing to spend, and that in aggregate is adding up to positive growth.
I keep talking about this quote, I don't know, rich European or somebody who just said, I don't want to be a rich person in a poor country. I don't want to be a billionaire in a poor country. When does the lower rung of the K, I think we were all shocked about the SNAP benefits and how many Americans are getting assistance when it comes to food in the world's richest country. So when does that, ignoring if you can even the social issues, but the economic costs too of that, and so when does that come home to roost? Or are we seeing that with government debt? I don't know.
Yeah, we've spent, we've run up a lot of government debt to try
on different things.
Right, on many things.
Right.
To sort of fill the gap, and that's been a positive. But, it's always about the jobs, right? People are okay until they lose a job.
Yeah.
So that's why the unemployment rate is so crucial to watch. And, of course, we don't really have that. We have now the Chicago Fed putting out their estimate, which is helpful.
Right.
That last one was 4.4%, a little bit above the last one we got from the BLS. But 4.4% is not a high unemployment rate historically. We used to think full employment was around 5%.
Right.
So, it's going to... If there's going to be a problem, it's going to be because people lose their jobs. That's usually the way it happens.
It's as simple as that. Not so simple if you're losing your job.
Right.
It's a big cost. Right. Kathy, so great to have this chunk of time to spend with you. Thank you so much.
Thank you.
Kathy Jones, Chief Fixed Income Strategist over at the Schwab Center for Financial Research, right here with us on Schwab Impact 2025.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.